Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fajita, and let's get you up to speed on this afternoon's market action. We're still looking at gains across the board, although the major averages off their highs of this session. We're still seeing that trade higher here following that softer than expected, slightly softer than expected CPI print out this morning. The S&P up just about 0.3%. Taking a look at that sector performance, communication services, healthcare among the outperformers. The Dow up just around 170 points. The outperformer by far in the Dow today is Disney, following their earnings results after the bell yesterday. And you're still looking at the Nasdaq holding on to gains up just about 40 points.
Well, the July CPI report showed inflation is moderating. Both headline and core CPI rose 0.2%, driven mostly by rent and food prices. But is it still too soon to declare it a win for the Fed and its goal of a soft landing? San Francisco Fed President Mary Daly weighed in earlier on Yahoo Finance.
It is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target. We don't control gas or energy prices or food prices, but definitely by bringing demand of the economy back in line with supply, we're going to get broader inflation relief. And that's going to be the thing that, I hear it mostly. I have 9 states in the Western United States. I can talk to any single person. I ask them, what's your number one concern about the economy? They still say inflation. More work to do.
Joining us now is Gus Fauché, Chief Economist at PNC Financial Services Group. Gus, good to talk to you today. You heard Mary Daly there sort of saying that the Fed's job is certainly not over yet. When you look at annual core inflation, we're talking 4.7%. So what does today's data today tell you about how sticky that last 2.5% or so is going to be to get to that 2% target?
Yeah, it's going to be difficult to get down to 2%, and it's going to take a further slowing in the labor market. On the good hand, however, we do see that inflation, core inflation outside of housing services, is falling pretty quickly. But housing is still an addition to inflation, and strong wage growth is still a problem for inflation. So I think it'll take some further softening in the labor market to get that core inflation back to the Fed's 2% objective.
Gus, do you think the Fed needs to hike again in order to get more softening in the labor market?
I don't think so at this point. We are seeing slower job growth. We are seeing wage growth ease off a bit. And I think that monetary policy at this point is still quite contractionary. The Fed funds rate is between 5.25% and 5.5%. That's weighing on economic growth. And I think given the slowing in inflation that we've been seeing, the slowing in job growth that we've been seeing, the Fed can keep the Fed funds rate there in the near term. And then if need be, they can raise it towards the end of 2023 if it looks like inflation isn't slowing as much as they expect.
So what does this all say about what the outlook is? In the grand scheme of things, we keep talking about the soft landing, but it really is about avoiding a recession while trying to pull back or actually cool down some of that inflation. It is starting to come down, but as we noted at the very top, we're still off that target for the Fed.
That's right. And again, monetary policy is still contractionary. It's still weighing on economic growth. I still think the most likely outcome is we get a mild recession starting in late 2023 or early 2024. But there's still close to a 40% probability that we get out of this with weak growth, but not an outright recession. So the Fed has been dealt a difficult hand. I think they're doing a reasonably good job of playing that hand. But the most likely outcome is recession, but there's still decent chance we can get out of this with some bumps along the way, but not an outright recession.
Gus, how are you looking at the uptick that we've seen in gas prices? We've seen a pretty significant surge over the last month, and I guess how much that's going to potentially here complicate the Fed's fight with inflation, at least in the short term?
Well, I think you heard President Daly say that they don't have much control over energy prices or food prices. So I think that they're going to look through that. I think we'll see a supply response that brings energy prices back down again. I think the Fed is much more focused on core inflation because that's what they feel they can affect. So I don't think that that's a big issue for the Fed right now.
You don't think higher energy prices are a big issue, even though that could potentially reaccelerate inflation?
Again, I think the Fed is more focused on core inflation, which is moving in the right direction, albeit slowly. And then I do think that any increase in energy prices is likely to be temporary, and the pass-through to core inflation is going to be quite limited.
Gus, when it comes to, and we're very far from talking about potential rate cuts or what that conversation will look like. In order for the Fed just to start potentially talking about it, what do you think, how much more progress do you think they need to see?
I think that they need core inflation that is back down below 3%. And we're a ways from that now. We will get some help from housing. I think we will get some help from a softer labor market. But unless we see a very substantial deterioration in the labor market in the near term or inflation that slows much more dramatically, I think we're probably 9 months away from a rate cut.
So, Gus, we're obviously looking ahead to that next FOMC meeting in September. But in between that, we've got the Jackson Hole Symposium in a few weeks. Does the messaging change at all, you think, at this point, given the data that we've gotten? Or is it still pretty consistent in terms of the Fed trying to keep optionality?
Oh, absolutely. Obviously, there's a lot that could happen to inflation, to the labor market over the next few months. The Fed has said that they're going to be looking at the data. We heard President Daly talking about that. And so I think that, the Fed will indicate that they're not planning to hike in the near term, but that if inflation doesn't slow as much as they're expecting, or if the labor market continues to run strong, that they are willing to raise the Fed funds rate in order to get that inflation back down to 2% over the longer run.
Gus Fauché, it's good to talk to you today, Chief Economist at PNC Financial Services Group.
Tapestry reaching a big deal here to buy Capri Holdings for $8.5 billion. We're seeing a massive reaction in Capri stock, up just about 55% right now. Well, the fashion giant saying that this is going to help expand their global reach. The transaction will see Tapestry, which is the owner of Coach, Stuart Weitzman, and Kate Spade, gain control of Michael Kors, Versace, and Jimmy Choo. And Kiko, when we take a look at what's been happening within the retail space, specifically within the luxury space, we have seen this pattern of consolidation. We know they are up against some stiff competition. LVMH has been viewed, I think it's fair to say, in recent years as the winner, as the leader, I should say, within this space. How much is this materially going to change, though, Tapestry's business going forward? I think a lot of people are starting to question that, just given the brands that they have under this umbrella and how much it still resonates, or how little maybe it's resonating with consumers these days.
Yeah, Shauna, that's something we were talking about this morning, right? I mean, if you look at the portfolio of brands that are under Tapestry and Capri Holdings versus LVMH, it's still pales in comparison to what LVMH has. Having said that, it is interesting timing in all this when you think about consumers increasingly pulling back on discretionary spending. What would the announcement today allows these two big retail names, American names, we should say, really to pull resources together in a big way? A number of things that companies have announced that two groups combined generate $12 billion in revenue. The merger will result in $200 million in savings. We're talking about in operations as well as supply chain costs over the course of 3 years. And then this really does increase opportunity in terms of direct to consumer opportunities for these brands. So strategically, it makes sense. If the question is, does this allow them to compete with the likes of LVMH in a big way? It feels like they're still a ways off.
Yeah, it feels like they are very far ways off. And it also took the street by surprise, a little bit by surprise. We're getting some analyst reaction today. BMO Capital Markets, Simeon Siegel, he was out saying that this deal was a surprise. He does view it as a positive for Capri shareholders. Remember, this is a stock that was off just about 40% so far this year ahead of this deal. But he was saying it's a little bit surprising given the similarity, the brand similarity, Akiko, you just mentioned, to U.S. American brands here, and also the momentum, the current strategy, potential execution issues which could arise and likely to arise with the combination of these two well-known names. So I think the future of it, and also just given the timing, like you were saying, with consumers thinking twice before spending on discretionary products, makes some people just second guess, I guess, what exactly the catalyst will be for these two names in the short term.
Yeah, I mean, having said that, when you combine these two forces, it does mean something for the brand. If you look at Capri Holdings, for example, they get more exposure to the Asian markets. Yeah. You look at somebody like Tapestry, more exposure to EMEA. So we'll still have to see some of those brands, their footprints expand and see how consumers respond. But yes, to your point, luxury brands, just like a lot of brands, certainly going to get hit because consumers are becoming increasingly conservative with their wallets. That space is certainly going to take a hit as a result of that. We're just getting started here on Yahoo Finance Live, but coming up, July inflation data shows convincing signs of price pressures easing, but is the pressure easing enough for the Fed? We're going to discuss. Plus, rising gas prices and cost of insurance are still hampering drivers, but buyers are getting some relief. And the FTC will meet with Amazon next week before the commission files an antitrust suit against the tech giant. We break down what that could mean from the final meeting later in the show. Stay tuned for more Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Let's do a check of the market sponsored by a Tasty Trade. We are seeing green across the board today. All three majors up as investors react to inflation cooling with the latest CPI print coming through. The Dow up 146 points, the S&P 500 up 12, and the Nasdaq up 44. Also taking a look at the VIX, the fear gauge. We have seen that moderate down about 1.75%.
Well, food prices ticking higher last month. The cost of food at home increasing 0.3% in July, but it's not the case across the board. Here with where some of the areas where pressure is beginning to ease, we want to bring Yahoo Finance's Brooke DePalma. And Brooke, we're going to walk through the meals of the day. So let's start with breakfast. If you're heading to the store, you're trying to plan your breakfast, where could you maybe save a little bit compared to what you would have been paying last month?
Yeah, well, believe it or not, we're going to start breakfast with some eggs here. I mean, we did see some relief there. Egg prices down 2.2% month over month, and even more year over year, down nearly 14% there. Now, this compares back to January when we saw prices jump 70% year over year. And so perhaps you should get some eggs to start your morning. Now, bacon dropped month over month, down nearly 0.7%, but year over year down 10.7%, nearly 11% there. And instant coffee also looking a good way to brew up your morning routine, I guess. Roasted coffee costing Americans more these days. Cereal also being impacted by consumer companies really driving prices higher. And so believe it or not, we're actually going to say eggs is the better bet as we move into this month over cereal, which is seeing a higher jump month over month.
And Brooke, what about lunch and dinner?
Yeah, well, it's lunchtime in California, dinner time almost here on the East Coast, so we'll dive into that a bit. Lettuce actually remains flat month over month. We were seeing a bit of a jump earlier this year due to California wet weather. Now we're seeing that flat month over month. Tomatoes slightly higher here, but potatoes costing more, so we'll go with tomatoes for this meal. Fresh fish and seafood actually down 1.1% month over month. One economist telling me that wholesalers and retailers are really trying to liquidate significantly higher cost inventory there that's being held in cold storage right now. So that really being the play here for lunch. But ultimately, apples and oranges, try to avoid that maybe as an afternoon snack because apples are costing 2.4% more month over month, largely because of the labor input and energy costs that we're seeing. Oranges, they were a short crop supply in California due to that wet weather. Now, dinner over here, we're getting some good relief in the poultry market, the poultry industry. Fresh whole chicken down 2.1% month over month. That's strongly related to U.S. companies having to market right, to price right compared to what they're seeing overseas when it comes to competition there. In addition to that, fresh biscuits also getting some relief, and soup also down 1.2%. But the big story here when it comes to grocery inflation is that uncooked ground beef and veal category is ultimately being driven higher this past month. So try to avoid beef and veal this month if you can. Ultimately, what we're seeing there is due to cattle being sold off because of the drought. They had to be sold for record prices. Now, as these producers look to rebuild their fleet of cows, or really their inventory of cattle, they have to feed them more. It's ultimately costing them more. And so we're seeing higher prices there. So chicken, soup, and biscuits, I guess, for lunch tonight, dinner tonight.
Not a bad meal. I was going to say your lunch meal was extremely healthy. You came back a little bit with dinner. And I also saw that their sweets are a little bit more expensive.
Sweets a little bit more expensive. Ice cream, more expensive as well. So if you have a sweet tooth like me, bad news there.
All right, Brooke DePalma, that was fun. Great stuff. Thanks.
Well, consumer prices showed a faster year-over-year increase in July compared to the previous month, as CPI rose 3.2% in July. That's a slight acceleration from June's 3% increase, and it's still well above the Federal Reserve's 2% inflation target. San Francisco Fed President Mary Daly spoke exclusively with Yahoo Finance this morning and had this to say about a potential rate cut this year.
We are a long way from that kind of conversation. We're right now trying to decide if the policy rate is high enough to be sufficiently restrictive if we held it for some time. But definitely you're bringing up a conversation that I expect we'll be having next year. I just can't tell you the answer to that conversation because a lot of that's going to depend on, the vast majority of that will depend on the economy and the path of inflation.
For more on what this means moving forward, we want to welcome in Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeffrey, good to talk to you today. So Mary Daly, they're saying that the conversation really is about whether those rates are high enough. But even if they are high enough, at the end of the day, it feels like we're going to be at these elevated levels for a while. What does that data point today tell you? What's your takeaway?
Well, I think that we need to look at the bounce that we're seeing today in the headline number as not being transitory. Inflation is going to be much harder to push down from here, meaning we've gotten used to this steady drumbeat of lower and lower numbers, and now that's being interrupted here. One driver for this is energy prices. U.S. oil inventories have been tumbling. The supply side is tightening as OPEC leader Saudi Arabia delivers on that hefty 1 million barrel per day cutback pledge for this month and next month, and said they could even go further. And CPI is now facing resistance to going lower from housing, which nearly makes up all of CPI in the U.S. at this point. But an adverse commodity price shock, as Mary Daly points out, while it's a real possibility, well, I'll say, especially given the El Nino extreme weather impacts on supply chains and production we could see later this year, we don't think that necessarily would mean that the Fed would hike rates. In fact, in the past, the Fed's reaction to a surge in commodity prices or some kind of commodity price shock has actually been to cut rates rather than hike them.
So, Jeffrey, given all that, I was going to ask before that last point there, do you think the market is being too optimistic then when it's looking at this print? Or given what you just said there lastly, maybe they are reading this correctly?
Well, I mean, the Fed can't completely take rate hikes off the table, although we believe they're done. And I think that means there'll be still some lingering concern about when can they really declare the victory over inflation and when might they begin to cut rates. I like to look at Brazil. Brazil began to hike rates 1 year before the Fed did. They paused rate hikes 1 year before the Fed did to the month. And maybe they've now started to cut rates. So maybe in August, next year, we start to see Fed rate hikes, cuts. If that's the case, that could be a little disappointing to a market that's already expecting rate cuts sometime early next year.
Jeffrey, you talk about central bank over in Brazil, but when you look at the major central banks globally, you've sort of highlighted this divergence we're starting to see. Obviously, the Fed has been out in front, the ECB a little behind, and then the BOJ just now trying to tweak that yield curve a little. What does that growing divergence mean for markets? To what extent does that inject more volatility?
Yeah, I think it does inject more volatility when we start to see this departure. We're so used to everything being in sync, and now we kind of get this divergence, and countries are looking at different levels of inflation now. Again, maybe it's stabilizing a little bit here in the U.S., not quite getting down to 2, but we're still seeing plunging inflation in Canada. It's coming down to the UK, but it's still high. So we're at different points in the cycle, and that can mean more volatility in currencies and more volatility in the markets. It's noteworthy that the VIX really came rocketing higher on that news that the BOJ was going to be changing their yield curve control. And that's because the VIX was frankly too low at 13, the lowest level since prior to the pandemic. The markets were just not braced for any event that could drive volatility. And I think there will be a number of events that could drive volatility in the second half of this year. That doesn't mean stocks have to go down. It just means the ups and downs are going to be more frequent and more dramatic.
So, Jeffrey, given that, then what should investors do? How do they protect their portfolios against some of that expected volatility?
One of the things I want to do is focus on markets where they're not priced for perfection. And one that stands out to me is Europe. Eurozone valuations are below average. The current price to earnings ratio based on the next 12 months of earnings for the Eurozone stock market is 12.4. That's below its 10-year average. And I think investors may begin to recognize the durability of this index. It's now outperforming the U.S. this year. And, the U.S. stocks obviously trading above their long-term price to earnings ratio do suggest maybe there's some risk and some vulnerability to any disappointments that might come along with this inflation data, disruptions tied to El Nino effects later this year, or changes in policy, particularly given the particular volatility around China's approach to managing their economy. So lots of potential risks there. I'm favoring those countries that are not priced for perfection. I find those overseas.
Jeffrey, what about the fixed income space? I mean, you were sort of highlighting what we're seeing in central bank policy. In many ways, what we're seeing abroad, not just the ECB, but a place like the Bank of Japan, could really affect treasuries at a time when we have seen higher yields. How are we likely to see that shift up, and where are you positioned in that way?
Yeah, so interest rates are stubbornly higher here, and I guess they've come down a little bit this week, but overall, they've been moving higher. What I'm finding is that shorter duration stocks, companies that get more of their cash flow in the near term, the way out in the future, are behaving really well. They've actually been the outperformers since interest rates began to rise back in August of 2020. And now with the yield curve changes from the Bank of Japan, returning money to Japan, that yen carry trade unwinding, there might be more upside to interest rates and borrowing costs. So companies that can fund their operations out of cash flow are being valued more highly by investors. We're seeing those shorter duration stocks based on low price to cash flow ratios really outperforming here. They stumbled a little bit with all the bank concerns earlier this year, but they're back outperforming again. I'd advise investors to take a look at that characteristic, low price to cash flow, as a winning one for the remainder of the year.
So Jeffrey, here we are almost in the middle of August, that second quarter earnings season. We're getting towards the end of it. We've seen a significant number of beats, 79% of companies posting earnings beat when we compare that to analyst expectations. What's been your big takeaway from earnings season so far?
You know, layoffs is what actually stood out to me so far this earnings reporting season. Sure, a number of companies are beating, but one of the reasons is, they're kind of looking at managing labor costs. We saw Canada's unemployment rate rise for the third straight month in July, joining other G7 economies. And what I'm seeing is that the commentary from business leaders so far this earnings season is reflecting more layoff announcements. Words like reduction in force, headcount reduction, job cuts, outnumbering those that talk about hiring or labor shortages or difficulty in filling positions, which had dominated calls all last year. And we're hearing this not just out of technology. We heard that maybe last quarter. Now it's CVS, it's InBev, it's Biogen, Qualcomm, money manager T. Rowe Price. So it's not just concentrated in tech. We could be starting to see a turn here in the global labor market with broader implications for investors. Remember, usually corporate leaders tell shareholders before they actually start to make those cuts. So we'll have to see how that begins to affect things here as we look out to the third quarter and beyond.
What does this also mean for labor costs? I mean, that's been one of those areas that we've heard, right, from so many of these companies that have been reporting their results, how much they've, for example, had to increase prices because the labor costs going up. I mean, are we going to start to see a pullback on the back end there too?
We could begin to see that. I guess Disney maybe hinted a little bit about that at the end of the day yesterday with their report, that maybe we're starting to see a little bit of an ease in some of those labor costs. I know it may not feel that way right now, given all the strikes taking place, but I think they're a lagging indicator. In general, what we're seeing is a tremendous easing in the demand for workers. We're seeing the job openings begin to fall. Like I talked about here with layoffs on calls, we're starting to see a number of countries now with 2 or 3 months in a row of a rising unemployment rate. So I think some of those wage pressures are going to begin to fall, perhaps in lagged effect here with inflation, and that should begin to brighten up the bottom line a little bit, but we have to temper our enthusiasm because at the same time, of course, that can mean less revenue growth as those workers also have less fuel for consumption.
All right, Jeffrey Kleintop, always great to get your perspective. Charles Schwab, Chief Global Investment Strategist, thanks so much for joining.
Thanks for having me.
Well, coming up, big name retailers gearing up to report their quarterly results next week. So which ones should investors buy and which should you sell? We'll break that all down for you when Yahoo Finance returns.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
Well, investors largely viewing today's CPI report positively, but there could be a looming threat to inflation, and that is energy. Yahoo Finance's Jared Blickery is here with a closer look at the energy space. Jared.
That's right, Akiko. Those headline numbers relatively benign and importantly in line with expectations. But when you dig down in some of these energy subcomponents, I'm seeing some huge month-over-month gains. Here in fuel oil, that's 3% up in only 1 month. That's 300 basis points. Gasoline up 0.2%. That's 20 basis points. Utilities 200 basis points. And only electricity, that's moving down 0.7%. That's moving in the right direction. But you take a look at some of these numbers on the year-on-year, a lot of them are down 10-20%. So what's going on here? Well, I think this is most easily illustrated with the futures market here. You're going to see prices reflected in the futures before they show up in the inflation report. And here we have our heat map covering the last year. Lots of symbols here. So I just want to point out a few things. Natural gas down 66%. Crude oil here, CL equals F, down 10%. And the only thing really gaining right here, we got softs and some livestock. But for the most part, energy has been under a tremendous amount of pressure when measured over the last year. But you change this to a 2-month look, and some of the biggest losers are now some of the biggest gainers. Heating oil, that's up 33%. That's HO equals F in the upper left. Natural gas, NG equals F, that's up 22%. Crude oil up 18%. So the trend over the last couple months definitely on the upswing, and this is being noticed by investors as well. Here's a 5-day look at the S&P 500 sector. You're going to see XLE, that's energy, that's up 2%. You take a look at the 1-month trailing results. Energy up 8.7%. That is the number one sector. Let's look at 2%. Energy, again, number one. But year to date, energy actually barely positive, 1.2%. So really within the last couple of months, things have really been on the upswing for energy. Now, just getting back to the original point here, when we're thinking about inflation, and I want to show this, this is separate but related. Inflation, the returns that we're seeing in the stock market overall, the S&P 500 on days like today, when we get the inflation prints, those have largely been tracking the overall market. In blue, I have SPY, that's the S&P 500 Spider ETF, and in orange, I have CPI reactions, and you can see this goes back 5 years. Since we got this October bottom, we have seen returns on CPI data, on CPI days, those have really outperformed. And that has been the basis for a lot of the gains we've seen this year. So I'm thinking a month ahead, 2 months ahead, if we see a big down reaction in the market on one of these CPI days, well, that could very well mean that the top is in, at least temporarily, on this market, guys.
Yeah, interesting to see those charts correlating there. Jared Blickery, as always, thanks so much.
All right, well, big name retailers, including Walmart and Target, gearing up to report their quarterly results next week. And it certainly is a tricky year for retailers as they navigate what is becoming a more cautious consumer. So what names should you buy and what should you sell? We want to bring in James Demmert. He's Main Street Research Chief Investment Officer, along with Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Great to have both of you. Brian, let me start with you. We talk about the fact that it's a tough environment here for retailers. More and more consumers, we've seen this trend over the last couple of quarters, more consumers starting to trade down. Walmart is one of your picks. What gives Walmart the edge in this environment?
As you guys have been talking about, inflation has been a big impact on bottom lines across the board. Just simply the cost of doing business, labor and supply chain issues have made things difficult for a lot of these retailers. But Walmart has been a cash flow generating machine. And the more cash flow that you have that you can reinvest in your own business without having to leverage right now is going to be a key difference as we go forward. I agree with a lot of the other comments made earlier today, and that interest rates are likely just to stay higher for longer than the equity markets currently have priced in. Not that we have a huge disagreement about we might be at the top terminal rate or one more hike to go, but we don't see the rate cuts in the future. And that just simply means the cost of doing business in the future continues to stay high. So these companies like Walmart that continue to generate an enormous amount of cash flow have that capital to reinvest in themselves organically and grow. And they've done so. They've made huge investments in their e-commerce segment, and primarily to combat what they have in terms of direct competition with Amazon, and they're gearing up their home delivery services. And so they're using that cash flow to their advantage in this highly competitive sector.
So, James, let's pick up on that point. I mean, Brian, looking essentially where consumers are going right now, especially with tighter wallets, talking about cash flow, investments in e-commerce. Is this a name that you would get in on? How are you looking at the retail space?
It is a name that we find attractive, without question. And one of the few rules that we have, particularly in what I consider a stock picker's market, is the three most important things in retail, which is brand itself, right? Management, and as Brian mentioned, debt indebtedness is very important here, that companies have very strong balance sheets and that brand awareness and really, really great management. And I think that's going to be a key issue as we go through the hurdles of stickier inflation and not quite some time before the Fed cuts. So we've got a couple names beyond the Walmart that we find very attractive here.
What are those, James?
The first is, back to our global style, a company like LVMH. Obviously, lifestyles of the rich and famous type of stock. But, there again, the one percenters tend to be pretty consistent through all kinds of economic climates. When we go back to our brand is important, these are probably some of the highest end brands in the world and well known and recognizable. Orno is probably one of the best managers of a business, and we do buy businesses. And again, debt levels are important, so we want to make sure the company isn't over its skis, let's say, in the indebtedness. So really the right mix. And here you have the stock down about 8% from its high. Really love that as an opportunity to add to the position, or if investors don't own it, here's a great time to do so.
James, really quickly, I'm curious to get your thoughts on the announcement that we got today of Capri and Tapestry, because we were talking earlier about as much as those companies combined bring in brands under one umbrella, it's still tough to compete with a name like LVMH, which you're invested in.
I think it is. I think that's a very good question. And Etsy sort of falls into that same trap where you've just got too many. You don't have any brands of significance. You just got a lot of brands, and I think that's going to be the differentiator for the successful companies over the next 12 months versus the others. So again, I would want to stick again with brand awareness, as like a Tractor Supply, which we can talk about as well. Has got that very significant presence as in brand awareness. Really, really important.
All right, James, we'll talk about Tractor Supply in just a minute. But Brian, I want to get your thoughts here just on the luxury consumer, given the fact that it sounds like you see a lot of the opportunity being at the other end of the market, the lower income market.
Well, and it's certainly that we don't acknowledge the luxury brand. There has been a lot of durability there in spending from consumers. And we think a lot of that has to do with the fact most of those higher end, higher income individuals were able to take advantage of the low in the rate hike and the rate cycle and refinance usually what is their biggest debt, which is their mortgage. And that has cleaned up their balance sheet. And so their spending has been growing even more so than what you would see in the low to mid income range. So there's absolutely a reason to have those types of companies in your portfolio. We think it absolutely makes a lot of sense. It doesn't mean that we don't like them. It just means that at this point, we're a touch more defensive, leaning a little bit more on free cash flow and operating income. And there's definitely going to be some consolidation, we think, in those brands that James was just talking about.
With that said, Brian, we started the conversation by talking about Walmart. There's another name that you actually surprisingly don't like, a direct competitor to Walmart. What's different here when you look at a name like Walmart versus Target?
Yeah, Target really over the last couple of years has had a difficult time managing their inventory, and they now have a new problem where they just acknowledge that they have, $500 million worth of shrink or theft coming out of the stores, and that a lot of it is because they have so much on clearance and on sale that's really impacted their margins for a very long time coming out of COVID. And this affected a lot of people trying to get their actual goods landed in stores, and it had a ripple effect when you had a whole bunch of non-seasonable wares in the wrong place at the wrong time. And so they made a decision to try and clear out that inventory and not have to wait on it. But it has impacted their margins to a point where there's a little bit of a capitulation in confidence in the company. And that's starting to get reflected in their margins going forward as well. And so it's not that Target is a bad company. They're just kind of stuck in a bad spiral. And they're really going to have to work hard to get out of that. Again, this puts pressure directly on those metrics that we like. Operating income, free cash flow, they've all been in pretty substantial decline over the last 3 or 4 quarters. And we don't see it improving until maybe 3 years from now that they can work themselves out of this particular hole.
Yeah, Target shares off just about 12% so far this year. James, getting back to what you just said a moment ago, and that's Tractor Supply. You talked about the brand awareness, but this is also a stock that hasn't done much since the start of the year. What's the bull case here for Tractor Supply?
Yeah, it's a stock like many of the stocks outside of the Super 7 tech that hasn't gone a long way this year. And I think that the valuation should be the first thing that's attractive, right? PE multiple versus growth. Then back to brand awareness. This is the leader in gardening and even farm equipment and all kinds of stuff that you'd like to do in the garden. And so one of the things and themes, outside of brand awareness, which of course they're the kingpin, is this incredible move by millennials, right, to the outer parts of more rural parts of the country and not just here in the States. So, Tractor Supply started in 1938. I mean, they are the brand. They're continuing to open new stores. So you had that expansion growth story, right? You've got brand awareness, as we talked about before, and wow, do they have high margins and extremely well-managed business, as opposed to what Brian mentioned, the Target situation, which is, sort of a mismanagement there. On the Tractor Supply, you've got excellent management, great valuation, and you've got that millennial push. They're opening stores, so all the right mix of a company that, yes, maybe hasn't done tremendously well so far this year, but probably will in the back half of this year into 2024.
Finally, Brian, let's end on a positive note, sort of staying in the home improvement space. Home Depot, one of those stocks that you say you like. We've seen a bit of a transition in terms of what is driving revenue for Home Depot. We kind of went through the pandemic where there was this huge push in DIY. Since then, it's kind of moved in a different direction. What are you liking what the company's doing right now?
Yeah, again, a lot of investments in where future revenue is going to come from at Home Depot. They moved away from that DIY segment and put a lot into their pro development. And these are the licensed contractors, the actual professionals that can come in and do projects for you. And that's been a big transition in their business. The last 20 years, they've been the DIY kings along with Lowe's, but now they've actually made substantial investments in where they see the future of revenue coming from. And there's a bit of a cycle in the consumer here where they absolutely did home improvements on their own. And then the value of their home went up so substantially, they started to sell it and trade up. And now it's coming back around to where people are going to want to have some projects and some improvements done. And Home Depot has by far and away made great investments in being ahead of that curve so that they can supply the contractors with everything that they need to get those jobs done. And that's important right now because the contractors are making more money now than they ever have been because of the short supply of their skill set and that skilled labor. And so being able to have a trusted partner where you can actually work very conveniently with your own personal representative online, again, in an e-commerce way, go pick up the materials that you need. It makes you more efficient. It makes you able to do more projects. That's better for your bottom line and Home Depot's. That's why we like them.
You've given us a lot to think about in the retail space, both of you, James Demert and Brian Mulberry. Good to talk to both of you. Really appreciate the time.
Thank you.
Well, Coming up, while gas prices have caused some pain at the pump, car buyers are getting some relief when it comes to the cost of cars. We're going to have more on that when Yahoo Finance returns.
More relief for car buyers. A July inflation report showing new and used car prices keep falling. Yahoo Finance's Pras Subramanian has a look at the details for us. And Pras, how big of a drop are we seeing?
We're seeing a continuation of the trend of car prices coming up both in the new and the used market. You see in the new market here, month over month, 0.1%, but year over year, up 3.5%. Now that is higher, but the trend is actually smaller increases over time. Last month it was over 4%. Now we're seeing a 3.5%. So we're seeing that sort of come back down to normal here. Used car market even more interesting there, down 1.3% in July alone and 5.6% year over year. That's a big change there. That's been accelerating as the year's gone on. So what's going on here? So we've talked to Manheim, who does a lot of wholesale auction tracking. They do that report every month, and they're finding that year over year, that number's been dropping 12 months in a row. So we're seeing a nice kind of change there for buyers. And this is because, we saw a steady, big ramp up in prices during the pandemic when supply was low and people wanted cars. So we're kind of seeing that return to normalcy here. What that means for consumers now is that we're seeing those new car sales and used car sales rising. We're seeing dealers having to offer incentives to people that buy cars because there's cars in the lot finally. So we're seeing that normalization there. We're seeing some deals there, late summer deals too for even new cars.
That's good, I guess, if you're in the market for a car, but still, they cost a heck of a lot, and people are strapped when it comes to cash, their wallet. They're looking for ways to cut, so it's a tough environment out there for automakers as well. All right, Pras Subramanian, thanks.
Well, WeWork on the verge of total collapse, and now it's threatening even tougher times for the commercial real estate market in New York City. WeWork occupies nearly 7 million square feet in Manhattan. That is more than double the amount of space inside the Empire State Building. Joining us now is Lee Overby, Barclays Managing Director and Head of CMBS Research. Lee, there's a lot of questions raised about this financial filing that came down from WeWork, where they said there was a going concern, often language that's sort of used with a company being on the verge of bankruptcy. How much of this was the company trying to gain leverage in some of its lease obligations? How much of this was about the company's standing right now? Regardless of which it is, what is the impact or the potential impact on the New York real estate market, especially when they occupy so much real estate?
Well, again, thank you so much for having me on. I think one thing that's important to point out is that the New York real estate market is really quite huge. So in spite of the fact that this does account for roughly, twice the size of the Empire State Building, it's still just a little bit over 1% of all outstanding commercial real estate exposure or office exposure within Manhattan. So from that perspective, it doesn't seem like as big of a number. One of the problems facing Manhattan and many cities across the country, though, is that already we are at record high vacancies, or at least, as far back as we've been keeping records for about 30 years or so. So this just adds one more straw to the proverbial camel of higher vacancies across the country.
So Lee, when you talk about the fact that this contraction phase that we've seen now for quite some time since the midst of the pandemic, it sounds like we're not towards the end of that yet. So I guess how much worse could this potentially get when it comes to office?
It's a very good question, and I wish I did have a solid answer. Many of us are trying to determine exactly that. This prior quarter has shown that the decline in occupancy has slackened off. So that doesn't mean we've hit a bottom, but it does mean that we are headed towards a bottom. So I would like to think that perhaps we will actually find another bottom by, call it, early next year. Then the other question comes about how long it will take us to dig out of this. So right now, this is a deeper contraction than what we had after the great financial crisis. And after that, we bounced along the bottom for about 2 years' time. So I really hope it doesn't take us to going on 3 years to finally recover from this. But if history is any precedent, it will be some time.
So Lee, I want to get back to some of that context you provided on what this all means, or what the potential collapse of WeWork means in that vulnerable environment that you just highlighted, because you recently put out this report talking about the exposure for WeWork, saying, given the current weak fundamentals of the office market, especially in New York, we believe these locations might be a particular risk of closure because of over concentration. What are some of these areas? What are some of these locations we're talking about?
Well, WeWork itself, at its heyday in 2018, it was, as you said, the largest tenant in New York, and it tends to take very high quality space and large amounts of space. And so for an office building in Midtown Manhattan, say, that has exposure to the tenant, if WeWork does indeed file for bankruptcy or does renegotiate that lease, it can leave a very large hole that the landlord might then have trouble filling. For various reasons already, these landlords are strapped for cash. And so this could be yet one more issue that the landlord will have to face in order to be able to afford the mortgage that's on the building.
So Lee, what does this do to valuations, and not just obviously when it comes to WeWork, but if we want to stick with New York City, could potentially the pressure it could put on valuations here across the board?
So already we have seen declines in valuations. Last year in September or October, we put out research that proposed a 30% decline in office prices. At this point, I would be quite happy if it ended up being just a 30% decline. We have seen some indications that already prices have fallen closer to 40%, and in some instances even more than that. So this is one more thing that we're going to have to end up working through. So maybe this moves the needle from, say, prices being down 40% to prices being down 40 to 45%.
What are we seeing on the side of buildings and borrowers? How aggressive are they being in essentially offering incentives that will allow these tenants to stay in the building?
We have seen some, well, in the case of WeWork, it's not clear that there will be any incentive that will convince them to stay. The company itself needs, it seems, pretty substantial restructuring, and it needs to get out of a lot of these leases. But away from WeWork, we have seen an increase in the amount of concessions that landlords are willing to offer. And we've also finally seen some slight downturn in the rents that they offer out. So right now, for any lease that's roughly 10 years, the concession package is equivalent to about 10 months of free rent. So this is near, again, record highs. And we expect to see that to continue as the landlords who are able to do so provide nice amenity packages to attract more tenants.
And finally, Lee, we've had so many of these conversations about what happens to these buildings, these big office spaces, when the reality is a lot of these companies just aren't going to get employees back at those desks. We've heard some of the space being used for restaurants, mixed use cases. I mean, what are you seeing? How do you think some of these buildings transform?
Another very good question, and one that I don't really have a good answer for. There have been studies that indicate that upwards of maybe 10% could be converted to multifamily, but the multifamily conversions are quite hard. There have been other things that have been proposed, such as conversion to a combination of retail on the bottom, hotel in the middle, multifamily on top. But really, the truth is, when we start talking about any kind of conversion situation, it usually entails wiping out the equity entirely, and usually a big chunk of the debt as well, because the conversions only work if the basis is sufficiently low. So I don't want to cast a pall over all conversions, but in a way, for the CMBS market, the commercial real estate market, your biggest wish is that the building next to you is the one that gets converted while yours continues as an office property.
Sounds like a high risk of more pain that we could see here in commercial real estate in the coming months. Lee Overby, great to have you. Thanks so much for joining us here. Barclays Managing Director, Head of CMBS Research. All right, well, coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned. The closing bell on Wall Street. Let's do a check of the markets sponsored by Tasty Trade. All three of the major averages closing in the green following that softer than expected CPI print out this morning. The Dow closing up just 53 points, well off the highs of the session. S&P just above the flat line. The Nasdaq up about 0.1%. So the market's giving back some of their earlier gains in the final couple minutes of trading. All right, let's take a look at some of the individual movers of the day. First up, Alibaba closing the trading session higher. We're still looking at a gain of just about 4.5%. Revenue topping expectations as its core e-commerce division returned to growth for the first time in a year. And Akiko, when we talk about the Chinese market, the recovery, lack thereof, that we're seeing this. I think this stronger than expected report caught a lot of analysts off guard, and the degree that they were able to beat some of these expectations, the magnitude of that beat. But e-commerce unit focusing on the lower cost items to attract more buyers. And at least for right now, it looks like that strategy from Alibaba is working.
Yeah, the backdrop of this quarter certainly adding to the enthusiasm we're seeing from investors and the numbers that came through from Alibaba. To your point, the company able to return to growth in this way at a time when we have seen growth pull back when you look at the overall economy over in China. What's going to be interesting to me, though, is how investors continue to value this company as they spin off those assets. Of course, Alibaba about to break off into 6 different pillars here because of that crackdown that we have seen over in China. So they are seeing a big bump today, but it's going to be interesting to see where that stock is valued increasingly as we see that transformation for Alibaba. Well, shares of Yeti closing the day higher after reporting mixed earnings for the second quarter, topping expectations on the bottom line. The company raising the lower end of their full year adjusted net sales outlook and increased their 2023 adjusted EPS outlook. That stock up more than 17% today, Shauna.
Yeah, certainly. We're seeing a lot of excitement around this report. And just to give you a better idea of how excited some of these analysts were, Jefferies was out with a note this morning saying that the second quarter shows fundamentals have bottomed, and they're saying buy shares right now. They were very encouraged by these results, raising their price target to $60 a share, reiterating their buy rating. So $60 a share, about $14 higher from where Yeti closed today. Gross margin expansion, inventories were also down big. They were declining about 34% on a year-over-year basis. So Jeffrey's saying that Yeti is well positioned to tap into some of that growth. And also they see Yeti maintaining some of that healthy cash flow ahead. When it comes to some of the other reaction that we got from the street, Citi saying that was a solid second quarter. Baird encouraged by the balance sheet. So Wall Street very satisfied with these results. Whether or not this momentum continues, given the fact that it's obviously a consumer-facing brand and consumers pulling back on their spending, it could potentially be a rough couple of months for Yeti. All right, let's take a look at Disney, the top performer by far in the Dow today, closing in the green, up nearly 5% after announcing subscription prices are going to be rising for its streaming services. This coming as CEO Bob Iger also said that the company is going to address password sharing, potentially cracking down on that. Initially, I mean, it was a mixed report, and we did see mixed reaction right after these results. But some of the developments, like the price increases that came on the call, also more of a focus, Akiko, on the narrower than expected losses in the streaming side of its business. Certainly reasons for the street and for investors to be encouraged about Disney and the potential direction here going forward.
Yeah, $512 million loss is what we're talking about in terms of the streaming operation. You think about where that is from the point of launch for Disney Plus back in 2019, $11 billion loss, or more than $11 billion. So Disney obviously making these efforts to really cut costs. That's been a big priority for them. So the street liking at least the company not only increasing the subscription, but also cracking down on password sharing. And you could argue, you know, Netflix kind of did the dirty work, right? They were able to push this forward. They have had success. Now Disney Plus following. We'll see where that goes moving forward.
Yeah, we'll see whether or not they see sort of a negative reaction in terms of the churn in subscribers, maybe cutting some of their subscriptions. But again, if they're raising the average revenue per user, then it's a win, at least in Disney's eyes. All right, let's talk about another big story of the day. Federal Trade Commission Chair Lina Khan is reportedly meeting with representatives from Amazon next week in what could be the last face-to-face between the parties before the commission files an antitrust suit against the tech behemoth. For more on what to expect, we want to bring in two Yahoo Finance reporters covering this story, Dan Howley and Alexis Keenan. Alexis, let me start with you in terms of the FTC's approach, what this could mean for the battle with the FTC against Amazon. What does that look like?
Yeah, so both, first off, Amazon, FTC, both not commenting on this alleged meeting. The reports are coming from multiple news outlets that it is going to happen next week. And what they would do is they would have the three commissioners meet with Amazon officials before the FTC decides on whether it will file an antitrust suit. That's usually put up to a vote for the three commissioners there. Kind of a last chance here for Amazon to make its case as to why the FTC should not come after it on antitrust grounds. But if it does file, we still don't know which of Amazon's many business avenues that would be the target. Some of the suspects would include Amazon's third-party contracts that it has with third-party sellers, those that block sellers from offering lower prices elsewhere on other websites, and also some practices that favor sellers that use Amazon's own services, its logistics, its advertising services, and maybe even Amazon Prime. Important to note here that nearly all U.S. states have already come after Amazon on antitrust grounds, trying to allege that they are overstepping their bounds in some of those areas. But the bottom line here is that if the FTC does go forward, it could ask a federal judge, it could ask its own in-house court judge to break up this $1.4 trillion company. And that's a really palpable risk. In just 2 years, a little over 2 years, FTC Chair Lina Khan has earned a reputation for going after big tech. It's not just Amazon. She's filed a case against Meta's Facebook, also another case against Facebook. One is still on target here. One is still pending. Another one was lost. FTC also filed and lost a case against Microsoft trying to block its acquisition of Activision Blizzard. And of course, the FTC here, not really alone. The DOJ going all the way back to Trump's administration, and also all of these states going after all of these big tech companies. So a lot to talk about at this meeting, but certainly a last-ditch effort for Amazon to be able to make its case.
Dan, as we've seen in past regulatory crackdowns, it's not always about who wins the antitrust lawsuit. It's about how the company changes its behavior as a result of the threat of that. What does this ultimately mean for Amazon?
Yeah, we're already kind of potentially maybe sort of seeing Amazon preemptively respond to this. There were reports, I believe it was Wall Street Journal, saying that Amazon is cutting back on some of its branding, its in-house private label brands, cutting those numbers down to maybe even 3 when it comes to apparel, things along those lines. They're going to keep the Basics brand, though, and that would help push off some of the criticism that they look at some of the sellers on their platform and then turn around and basically copy what they do and become a direct competitor. So that would be one of the ways that we could see them respond in the long run. They haven't really responded to the questions about that yet. They haven't responded to the questions about whether or not they're going to actually meet with the FTC either, obviously. But that's one of the ways. The other way is, they could face some kind of potential remedy where they come to an agreement with the FTC, where they'll change certain business practices. Maybe they eliminate the need for companies that work with them to use their freight or their logistics services. We also don't know if this is going to include Amazon's web services, its cloud division. That's another big piece of the puzzle for Amazon and could also potentially be up for investigation or potentially a lawsuit by the FTC. So there's a lot going on here for Amazon. Let's not forget about the whole video aspect, music aspect. It's a huge business. And they try to wrap everything together. The FTC already has a lawsuit against Amazon with regards to people accidentally signing up for Prime and then Amazon allegedly making it difficult for people to cancel the service. So, there's a lot going on here between the two. Lina Khan basically made her bones on the Amazon antitrust paradox paper that she did for the Yale Law Journal. So we'll just have to see if that kind of rigorous examination of the company ends up paying off for the FTC and for her, or if Amazon can come out on top whenever something is filed.
We will see how this all shakes out. All right, Dan Halley, Alexis Keenan, thanks. Well, coming up, if you're looking for a job, you may have come across the term September surge. Well, we will discuss the latest hiring trends on the other side. Stick around.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement. What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
People who receive Social Security are set to have their monthly checks increase, but by much less than last year. Yahoo Finance's Carrie Hannon is here with more. Carrie, how big of a raise or lack thereof are we looking at?
Well, we're still crystal balling it a bit, but today, the Senior Citizens League, who estimates what we might see happen, periodically based on what comes out. Now, today, we had the numbers come out from the Consumer Price Index, of course. And so they base it on those inflation numbers. And so they came to 3% bump up. It's their estimate for next year. And that would be a little under $54 a month in a beneficiary's check. Now that compares to last year when we had starting this year in 2023, we had an 8.7% bump up, which was, closer to $140 a month. So it's quite reduced from that. One caveat I would say is, this is one thing that actually is not fixed for retirees. Social Security actually does adjust based on inflation. And so the good news here is inflation is cooling. And so that's why, in fact, this number is estimated to be less for next year. But let's keep in mind, this is still a little bit early in the game to throw a hard number at this, because what happens is Social Security takes the number, the average July, the inflation index for July, for August and September, and averages those together. And so they will announce the number in mid-October of what Social Security recipients will see next year in their bump up in their check. So right now it's looking the way inflation is running, going to be around 3%. And that's fine on one level, but here's the thing. It doesn't necessarily reflect what seniors are feeling in their pocketbooks, right? Healthcare is still extraordinarily expensive. Housing is expensive. So, there's a concern, and Mary Johnson, who I spoke to today over at the Senior Citizens League, said that's what they're hearing again and again from people, their concern about the rising costs and will this be enough?
Yeah, Carrie, that was my question, because there's the headline number that we look at inflation. You sort of look at the number side by side, and yet there's the real cost of living. And to what extent does that bump really reflect that? Are we seeing more of a divergence here? You talk about the cost of healthcare, for example. If you look at that alone, how much higher is it?
Yeah, and the interesting thing is that they don't, the index that's used to measure what the index will be, the inflation number that they're going to use to come up with their number, doesn't necessarily reflect. They say something like healthcare expenditures, they figure will be roughly 7% of someone's budget, which in fact, that's a younger person's number. It is not somebody who is actually receiving Social Security. Their healthcare costs, and I'm talking out of pocket after Medicare costs, are really on the rise, and it's something that people really need to prepare for. And this number doesn't necessarily reflect that bump up in the just prescription drugs alone.
Yeah, certainly costs rising almost across the board. All right, Carrie Hannon, thanks so much.
Well, if you're looking for a job, you may have come across the term September surge. That refers to the idea that hiring picks up in the month of September, but there's data out there that paints a different picture. For more on this, let's bring in Mandy Woodruff-Santos, Yahoo Finance contributor and co-host of the Brown Ambition podcast. So Mandy, let's start with that term, September surge. Is it all a myth?
Yeah. Listen, it's basically a myth if you look at the data, right? But data rarely is always the same as anecdotal evidence, right? But BLS data, according to the Muse, doesn't actually show any major lift in September. In fact, June, I think because a lot of managers are trying to get the heck out of the office before their summer vacations, is the month with the most hiring on average. But September, not so much. What I want people to understand, though, is just because there's not some, big headline making surge in September, it is pointing towards some lift toward the end of the year, which I think also makes sense because managers, again, are wanting to get out before the holidays. They're also finalizing their budgets for the new year in Q4. So whether or not the surge exists or doesn't exist, I do think that after the summer break's over, people are back post Labor Day. It is a great time as a job seeker or as an employee wanting new offers to be, taking some steps to get yourself noticed by great opportunities out there.
So Mandy, how do you do that if you're a job applicant, you're looking to stand out against the masses? What are a couple steps or a couple of things you can do to better position yourself?
I was just on a coaching call with a client earlier, and I can never say this enough. It doesn't matter if you are incredible at what you do. If no one knows how incredible are you, it's like, did a tree fall in the forest if no one heard it? You can't be the best kept secret. You've got to get yourself out there, whether it's by, redesigning your LinkedIn to focus on your core strengths, your core talents, to attract the kind of jobs that you want, by sharing your activities, sharing your awards, your accolades, the work that you do, and connecting with your network so that they know what you're up to. You can't be the best kept secret, so put yourself out there. All right. And then from there, I just want to tell people to don't just wait for a certain time of year. Always be looking, always be passively job searching, and think about your specific industry. If you're in an industry where things ramp up in a certain quarter or season, then focus on, being prepared by then. But also use your time wisely. Think about, how can I take steps to, whether it's upskill, take on some new responsibilities and contributions to really beef up my resume so I can even be more appealing to hiring managers in the future? What can you do now that can help move the needle down the line?
Mandy, there's still a lot of debate, I imagine, within companies about remote versus in-person work, maybe hybrid too. Yeah. We got that headline a few days ago that Zoom was calling on their employees to go back to the office, which maybe a bit of irony given that their product is used for remote work. How are companies thinking about this now? And, to what extent is that critical in attracting talent, the flexibility?
Right. I honestly wish there were more debate about it. It doesn't seem like employers are really much listening to what employees want, because if they were, I'll tell you, they never would be going back to the office full time. I am heartened to see that although we are, of course, seeing this big surge, this big uptick in companies requiring workers to come back in the office, that at least we're in this hybrid middle ground space where a lot of companies are not saying 5 days a week, full force, 3 days, maybe being flexible. But absolutely, if you're a company who's in a really competitive market and demand for, workers with the skills that you need is really high and you want to attract some talent, just offer 100% remote work and say that it's permanent. And I promise you, you will have people banging down your door looking for those opportunities.
Mandy, you have a great pulse through your clients just on who's hiring, who's not. I'm curious to get your perspective on an industry basis. where are you seeing, or I guess what industries have the most opportunities right now?
Well, let me just tell you, I went on maternity leave in May. And while I was out, several of people in my community who had been long-term unemployed, I'm talking since December, even earlier last year, one who works in food and beverage and one who works in beauty and hair brands, both, one of them had a full job offer, one's about to get one. So jobs are still being offered. The women that I work with who are in tech and have very tech specific roles still are in a position where a lot of companies are not hiring. They've just had major layoffs. And even if they haven't had layoffs, tech leadership is being super cautious right now. So those are the trends that I'm seeing, just that there are bright spots. Women I know have been getting raises where they work and getting jobs in their sector. But yeah, if you're in the land of Silicon Valley, you're not seeing a ton of incredible opportunities right now. But I'm going to tell you what I tell my Mandy moneymakers, which is to stay strong, stay optimistic. Your time is coming. Long-term unemployment is so tough mentally and psychologically, but you got this. Okay, it will not be forever. It is just a season.
You're speaking to a lot of people out there. Some good advice. Mandy Woodruff Santos, thanks so much for joining us today.
Thank you.
Let's do a check of the market, see how things close. This market check sponsored by Tasty Trade. All three of the major averages in the green. The Dow up just around 52 points. The Nasdaq about 0.1%. S&P just above the flat line. Some mixed action here. When you take a look at the sector action, communication services, consumer discretionary among the outperformers, but losses in utilities, real estate, and industrials keeping some of the gains that we saw in the broader market in check. All right, well, coming up, Elon Musk is getting rid of anything that resembles Twitter by auctioning off items from the company. We're checking in on some of those top trending stories on the other side.
Welcome back to Yahoo Finance. Josh Schaefer here with Brooke DePalma and Pras Subramanian, talking about some of our favorite stories of the day, some stories that caught our eye. And guys, I have my eye on the amusement parks today, and specifically that overall space, looking at Six Flags earnings coming out this morning. I think the stock closed down about 5% as they didn't quite meet street expectations. As you can see their revenue coming in at $443 million. The street had been looking for $457 million, and then adjusted EPS also coming in a bit under what Wall Street had expected. Interesting though, revenue still up from last year, attendance still up from last year, but sort of an interesting overall dynamic playing out with parks. And then you think about what Bob Iger said on Disney's earnings call last night about parks. And I want to play a bite for you guys of what Iger had to say last night.
We saw softer performance at Walt Disney World from the prior year, coming off our highly successful 50th anniversary celebration. Also, as post-COVID pent-up demand continues to level off in Florida, local tax data shows evidence of some softening in several major Florida tourism markets. And the strong dollar is expected to continue tamping down international visitation to the state.
Pross, it just stuck out to me because it's something we've talked about when we were talking about the lowering attendance numbers we had seen at Disney, right? And Disney didn't fully address it. Iger obviously addressing it there last night. And you just wonder, is all of that coming back? Is the visitation going to fully come back? Or did we sort of hit that COVID peak and now we're kind of past COVID peak demand and maybe the revenge travel is just going away a little bit?
You know, I think that's definitely a big piece of it. We know we spoke about how higher temperatures in Florida may be affecting attendance, but then you had heard Bob Iger talking about the anniversary last year. That was a big year for them. It's going to naturally curtail up, but also they are seeing some weakness there. With Six Flags in particular, I was reading about how you mentioned revenue up, but spend down. They're seeing a lot of their flash pass or their season pass users come in, not the people that are spending on day passes. So that's hurting them. It's seeing a more like cost-conscious consumer coming in to still want to go out but not spend a lot of money. And I think this is part of that post-pandemic revenge travel, revenge fun, whatever you want to call it, going back a bit. People are saying, hey, I need to spend a little less money.
Right, consumers certainly pulling back here, especially on these sort of extravagant adventures that they were going on post-COVID, and attendance coming in, you know, increase year over year, but coming in short of expectations there. And really what we're seeing across the board is, I'll be honest, I didn't realize how expensive these tickets were. For Six Flags, it's like $35 to $70. For a standard theme day park pass at Disney, $109 to $189. I mean, for a family of four, you're talking upwards of $500. That's not something that the everyday American necessarily put out and do, as we're continuing to see this value-conscious consumer here in the U.S. And also, as you mentioned, Six Flags saying that they had a challenging weather environment in the second quarter with unusually high rainfall. But it's, you know, how much can you blame the weather on, you know, I've been to the park in the wet weather, I'll be honest. And so, you know, it's definitely a challenging environment overall.
You do wonder with the heat, though, too, specifically what they were saying in Florida. That stands out to me because I don't think it's going anywhere. And in the long run, if we continue to keep having hotter and hotter summers, how do you sort of counteract that when you are an amusement park? Because personally, if it's 100 degrees,
I'm not going.
I'm not going.
Yeah.
Maybe the water park, but I'm not going on an actual roller coaster where
so
the seats
Blizzard Beach might be seeing the increase in attendance, but not the Magic Kingdom.
Exactly. Well, I mean, maybe you cut prices for, I mean, I know they do have dynamic pricing, but maybe you cut even more, and that's probably not where they want to go. Turning now to another company we're watching, Lyft here, kind of leaning in on the ad game. They're going to start expanding their ad product services within things that you see within the app and things like that, following Uber's footsteps. Uber, I think, now hitting a $650 million annual run rate for revenue from ad business. This is the high margin, good business for them. So I'm not surprised to see Lyft go there. But the thing with Uber is the big difference is that they have Uber Eats, and they have a lot of restaurants that are gonna direct. Geographically locate you and find, hey, go to Papa John's for this pizza deal. Hey, go to, my favorite diner for French fries and burger, whatever. So like you're seeing that's a stronger business, a stronger model for getting those targeted ads. I don't think it's not as powerful for like a regular sort of, with Uber's ride apps, or even like Kroger's and people like that target them. It's not as powerful as the Uber Eats app. So I think Lyft can follow them, but I don't know if they can get that big performance.
They're the same amount of revenue, right? Because if you don't have as targeted of an ad as someone that's looking to advertise as a company, I'm going to pay less for the ad, because it won't be as effective, right?
CPM for Uber, but I just feel like the Uber Eats is like, that's the powerhouse. Like that's where you get people
It's attracting everyday people. They're looking at this constantly. They're ordering foods and ordering rideshare. And we know that Lyft has had a little bit of trouble diversifying their portfolio. And actually, when I went to an event, Lyft had launched airport travel earlier this summer. And when I asked the CEO for other opportunities like this, other extensions like this, he said, we're certainly looking at them. Perhaps this ad is one of them. But they are also expanding this ads on their bike offering. So here in New York City, that city bike offering that we're seeing. but that's only in a few cities. So like you're saying, the reach, the intentionality is there, but it's just how far is that reach when you compare it to Uber.
And they're also doing like the in-car displays. They have 6,500 in-car displays.
I thought that was really interesting.
They actually have the signs on top of the cars.
Yeah.
That's a business too, but it's not anywhere near the scale of Uber.
Well, it's putting it in the app just makes so much sense too. It's kind of crazy that we're just talking about this now with how long Lyft has been around. You would think the app pop-up ad make me watch an ad every time before I order. I almost called it an Uber. Before I order a Lyft, right? And then make me pay $1 or something for premium if I don't want to watch ads and I want to be able to use the app quicker.
It's
but
annoying before
you should
you
have
order
a
a
I don't
car
think
and
I
we
would
can watch
want
a video.
that.
you could make money off it. You're going to want the car.
Yeah.
You're using it because you need it.
Right.
So you're kind of a captive audience in some way when it comes to ads. So I would think that you could start really putting a lot of ads into the platform.
I really think Lyft, though, here, it really needs something to compete with that Uber Eats profile. And I think that in addition to that, as we continue to try to see them try new innovations, the CEO did tell me that there was a lull in the rideshare during COVID. There was not much innovation there. And so perhaps this is hinting at just some bigger opportunities for Lyft to gain that market share and ultimately be attractive. You know, I'll admit sometimes it's whatever is the cheapest for me, I'm going with, whether it's Uber or Lyft, especially here
I
in
don't
the
price
city.
shop that much on them.
Oh, really?
Yeah.
Oh, I always price shop.
Do you use both?
I price shop at the airport.
Okay, yep,
The
definitely.
longer, around here, no, but at the airport, yes, for sure.
Absolutely. Well, you know, social media platform X, formerly known as Twitter, is running an auction, selling off all their memorabilia, all the office supplies even, and bids are starting September 12th. It's going to run for 2 days, starting at $25. And what I find most fascinating here is really just the fact that they're going all in on this redesign, yet the URL is still twitter.com. So where are we at here?
I mean, this is more of Elon just being kind of a clown here, right? You know, it's like, you're really going to move the needle selling office chairs and signage.
Refrigerators.
I should say him being a clown. It's more about him being like, this is how serious I am about changing the whole look and feel, the vibe of the company. It's no longer Twitter. It's going to be X. Although the website title remains, but it's more of a symbolic gesture than an actual, we're trying to raise some money here, right?
Yeah, where's this money going?
I bet some of that stuff could sell though. When you look at some of the products that they're putting out there, like there's a coffee table that is like the Twitter tweet board, whatever.
The Ellen DeGeneres photo, right?
Yeah, like there's some stuff that's like actually kind of cool, especially if you were someone that liked Twitter. I don't know how much you're, like, again, like you said, it's not meaningful amount of money, but it will get more than $25 for a big coffee table. For one of the big coffee tables.
Oil canvas, right.
Yeah, I don't, the sign from the outside.
The sign outside. And some of these are done by, you know, high-end artists. I mean, that 2014 selfie, when I saw that being sold, I mean, that brings up some sort of nostalgia. I feel like for many, Twitter started, believe it or not, 2006. And so this company, you know, nearing 20 years now, and I guess in a new format, but there is like sort of a nostalgia factor when it comes to this bird that may resonate with potential customers.
Former employees.
Maybe some of the rich influencers that have used Twitter over the years, right? That are kind of those Twitter power users.
Or it's a relic too, right? It's kind of like, if it's going away, this is it.
Yeah, if I was hosting my own YouTube show, it'd be a cool thing to put behind me, right? Like it's that kind of, imagine having some MySpace merch. Like I think there's a little bit of a model there.
And also too, I didn't realize on this auction website, we also saw Pfizer and Canopy Growth selling off some of their back-end equipment. And so perhaps this is a bigger market than we realize. Perhaps Twitter, or X rather, is not the first one.
Secondhand business.
Interesting auction. Yeah, exactly. The corporate auction business.
The corporate auction business may be bigger than we thought, but really here, I mean, when you think about all these items, all this nostalgia, starting at $25, I mean, typically this stuff could go up to thousands, maybe even higher.
I think they should think about selling ads. I think X should be focusing on selling ads instead of old Twitter.
Well, I wonder. I wasn't Linda Yaccarino on another network today talking about the business. I wonder if this came up. The sale of these items, like, is it a distraction? How do you get those advertisers back on board? Sort of thing.
Another
it's all
thing
about
to
diversifying revenue.
The auction's happening at the office too, so where are the employees going during that time when we know Elon has been trying to bring employees back?
Yeah.
All right, we'll bring the rest of the
Mr. Musk,
conversation.
we're wondering.
Right, we got to bring the rest of the conversation over to X. We'll have that online. But coming up next, we're going to break down what is going on with the NFL. You're going to be able to get Red Zone right to your phone this year. We'll have all the details coming up.
The National Football League is joining the streaming price boost trend here. The NFL significantly raising the price tag for its NFL Plus streaming service. Also shaking up, I guess, the package here. So here to break it all down, we want to bring in Yahoo Finance's Josh Schaefer. Josh, as a consumer, I'm a little nervous for what you're about to tell me, but what do we know and how much are people going to be paying?
So the prices are going up, but part of the reason the prices are going up is because you're actually getting a new product here. So there's 2 tiers now for what the NFL is offering for its direct-to-consumer service. You have a $6.99 tier, and that really just gets you NFL Network, which NFL Network is great, and they have some games, but realistically, you want NFL Red Zone, which you can now get straight to your phone or straight to your TV for $14.99 a month, which really, when you think about Red Zone, so Red Zone is that 7 hours of constant football, commercial-free football with Scott Hanson that a lot of fans love it, right? It's the fantasy football gambling thing that people love to watch now. And so to be able to get that as a streamer, as a cord cutter, and not have to actually have any sort of cable service is a big move for the NFL to get into kind of creating their own content too when you think about streaming it. And maybe not the favorite move if you're Google and YouTube TV, who just started launching this product this year. They just got NFL Sunday Ticket, and part of that Sunday Ticket upgrade can be Red Zone. So now maybe a few less people get Sunday Ticket and just get Red Zone straight to their TV.
Josh, what do you think this says about how the NFL's thinking around streaming, just digital, is shifting? I mean, we've talked about this before. Yeah. Sports are really, I would argue, the only reason people have cable, right? So you've got these big cable broadcast rights, and yet it feels like a league like the NFL is kind of trying to navigate both ends.
And it seems like they've been smart to sort of protect one of their most valuable assets here, right, Akiko, and not selling Red Zone exclusively out to Google and out to YouTube TV. That was part of the negotiations that it seemed like different companies were stuck up on. You remember Apple initially was very interested in this package, and they sort of backed out. There had been some reporting out there that Apple wanted everything, including all of the rights to Red Zone. And the NFL has been very good and very close at sort of protecting their assets. And I do think there is a direct-to-consumer part of this where they know that at the end of the day, being a league nowadays is also being a media company, and sort of owning being that media company and being able to distribute it directly to your fans. I mean, this is revenue now that will go right back into the NFL's pocket, and they don't need a broadcaster to do it. Something that you have to be at least a little bit concerned about, I think, if this goes well, if you're one of these companies that's getting into sports streaming. To have a league do this successfully isn't exactly great if you're trying to be a sports broadcasting streaming company.
Are you going to do it?
Oh, I'm definitely doing it. $60 for the whole year.
I was going to say,
that's
it's
a steal.
Not a bad price tag, especially if you're a diehard, and I know you park yourself right in front of the TV on Sunday. So you're getting your money's worth, that's for sure. All right, Josh, thanks.
Well, July CPI print showed prices are continuing to moderate, with headline inflation up just 3.2% over last year. So is the Fed's fight with price rises coming to an end? Yahoo Finance's Jen Schomburger spoke exclusively with San Francisco Fed President Mary Daly earlier today.
So the CPI data came in largely as expected, and that is good news for families and businesses who have been fighting against this high inflation. It's also consistent with what we believe will be happening, which is that inflation will gradually make its way down. But it is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target.
Looking ahead, I know you like to focus more on the core number, but we have seen oil prices jump by some 14% over the past month. Do you worry that that could create upward pressure on inflation, just as we're starting to see things ease, see that creep into the core number, and as you're nearing the end of your rate tightening cycle?
Well, I think that's a terrific question, because what I always say is that Americans pay for gas and food. And so while they are volatile and they move around a lot, those are headline numbers that hit people directly in their pocketbooks. Unfortunately, we don't have tools that really work against those. Those are globally traded and those are going to be volatile. And one of the reasons we're so committed to getting core inflation down to its pre-pandemic levels is because that gives some families buffers, businesses buffers, when energy prices and food prices fluctuate, as they always have. But when you're facing high inflation, above target inflation on everything you purchase, and then you get a big increase in gas or food, well, then that's really distressing to families and businesses as they make their way through this economy. So we don't control gas or energy prices or food prices, but definitely by bringing demand of the economy back in line with supply, we're going to get broader inflation relief. And that's going to be the thing that, I hear it mostly. I have 9 states in the Western United States. I can talk to any single person. I ask them, what's your number one concern about the economy? They still say inflation. More work to do.
Do you take any solace from the past 2 cooler job reports that perhaps supply and demand is coming back into better balance in the labor market and could put downward pressure on inflation?
I see those rebalancing of the labor market as a very necessary part of what we're trying to do. It's also expected as we raise the interest rate, the economy cools. And as the economy cools, then employers need fewer workers and the labor market comes back into balance. There's really this important thing that I think all listeners, as they navigate what's the Fed doing, can be helped to understand, is that we are definitely focusing on how things are, the green shoots, really, the cooling of the economy. But we're also quite mindful that we need about 100,000 jobs per month to keep things steady. We're adding, 200,000 jobs a month. So we're still at levels that are higher than we will expect in the longer run. Same with inflation. Inflation's coming down, but it's still too high. And we really have to think about how does that affect our projections of what inflation in the labor market will look like, say, in 6 months, and then what should we do with policy to make sure that we achieve both our goals, price stability and full employment.
So then, given the latest data, how does that inform your outlook for inflation? And you say there's more work to do. How much more work is there left to do?
Well, that's a question that, I don't have a direct answer to. So what I do know is this, that there's a lot more information coming in between now and our next meeting, and certainly between now and the year. And, I use the word information instead of data because it is, I think, a misnomer. And in fact, I heard the earlier part of your programming that says maybe the Fed looks only at the headline numbers, whether that's on inflation or the labor market or housing prices. We are actually looking deeply within the data and asking questions like, what are new rents doing? What are people feeling when they go out and lease their first property? Or what do my contacts say about, are they going to hire workers next year? Are they cooling off? How much price pressure do people feel when they are out in the marketplace? Those are all the information sets we have. And being data dependent as a Fed means you're taking all of that information in and you're using it to project what we think will happen. And so as I look at that, I see slowing in the economy, but not there yet. And that's what my contacts across the district tell me, whether I'm in, Alaska, Hawaii, California, Idaho, Utah, Arizona, I could keep listing them. I hear the same thing. Yes, the economy is slowing down. It feels less frenzied, but boy, it's still hard to find workers. If you're a worker, it's still hard to afford things, even though you're making good wages. It isn't really quite in balance. And that's the important work that we need to continue to do as a Fed. How we do that, whether we raise another time, hold rate study for a longer period, those things are yet to be determined. And it would be premature to project what I think would happen because there's a lot of information coming in between now and our next meeting.
I know you just said there's a lot of information coming in. It's premature to project, but going into the last FOMC meeting, you were of the mindset that a couple more rate hikes did make sense. Surely you hiked by 0.25 percentage point 2 weeks ago, leaving perhaps one more rate hike on the table. Do you still feel that one more rate hike is on the table at this point?
So, I think this is a really important thing to highlight. Back in June, the FOMC, as it does 4 times a year, put out the summary of economic projections. And then the summary of economic projections in June, we'll have another one in September, but in June, the median of that summary of projections was that 2 more rate hikes would be required to really bring policy rate up to its peak rate before we would hold it. And then what we've been doing since, and I would be one of those, as you referenced, been watching the data and asking, does anything we're seeing change the outlook? So I have another projection I'll need to write down in September, and I'm watching the very data you talked about. But again, the inflation data right now, this is just a good data point. It says that data point is in the right direction. But as you yourself mentioned, oil prices are volatile. They can rise. We could get, if core services ex housing stalls out and doesn't continue to come down, that would be information. I'm listening to my contacts. They're telling me inflation's too high and they're worried about reacceleration in some areas of housing. These are all things that make my decision for me. So that's why I'm going to hold myself to this. Data dependence. I was very supportive of the rate hike we took, and I'm very supportive of not prematurely projecting what we'll be doing. There's a lot of time between now and September when I have to write down another projection, a lot more information coming in.
So then what would you need to see that would make you feel comfortable moving to an extended hold?
What I would need to see is a continued, really gaining confidence that the path of inflation is completely downward, right? And that is really not food or energy prices, because those are, as we talked about, volatile. It really is in goods price inflation, which seems to be on that path. It just keeps coming down. Housing price inflation or shelter price inflation, which is absolutely something we project will be coming down more, as we get through the year, because first it happens to home prices and then it filters through to rents. And if you look at new rents, new leases, you can use a lot of these disaggregated data by geography, and you see that those are pulling this down further. So that is something I expect to happen. The real piece where we're going to be doing a lot more thinking and watching is in this core services without housing included, ex-housing, super core, some people call it. That is a big component of spending for people, and it's something that has really not made much progress so far. Now, that's not surprising, really, because it's less interest rate sensitive, but we do need to see that come back to pre-pandemic levels if we're going to be confident that we can get to 2% on a sustainable basis. And I'm going to need to see some traction in getting there before I feel comfortable that we've done enough.
Our thanks to San Francisco Fed President Mary Daly, as well as Yahoo Finance's Jennifer Schomburger. All right, well, coming up, it's closing time here on Yahoo Finance. We'll recap the top stories of the day and also get you set for everything you need to know ahead of tomorrow. Stay tuned.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. The Supreme Court blocking a $6 billion opioid settlement by Purdue Pharmaceuticals. The deal was reached as part of its bankruptcy reorganization, which protected the Sackler family from civil lawsuits over its role in the opioid epidemic. That is part of the settlement that is being challenged by the Biden administration. The Supreme Court will take up the case and hear arguments in December. Plus, mortgage rates nearing 7%. The latest data from Freddie Mac showing the rate on a 30-year fixed mortgage was 6.96% last week, ticking up for the third week in a row. This coming on the heels of the July CPI report, which showed that shelter costs contributed to 90% of total inflation last month. And Virgin Galactic sending its second commercial flight to space on Thursday. It was the first time with paying customers on board. This mission was Virgin Galactic's 7th space flight to date and its 3rd since May. The company, by the way, is facing a backlog of 800 passengers.
Time for what to watch on Friday. We'll get another read on inflation, this time at the wholesale level. The producer price index is at 8:30 a.m. Eastern time. Excluding food and energy, economists expect July prices to climb 0.2% on a month-over-month basis and up 2.3% from a year ago. We'll also get the University of Michigan's preliminary reading on consumer sentiment. The index is expected to edge lower after climbing 2 months in a row. July's print, the highest in nearly 2 years, was largely attributed to cooling inflation and also a resilient labor market. That does it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time. We've got all your coverage leading up to and after the closing bell. Have a good night.